Retiring from dividends in just 10 years and starting with our dollars sounds like one of those too good to be true promises, right? But guess what? It's entirely possible. No, this isn't a get-rich-quick scheme or a pitch for some gimmick. Instead, it's a methodical approach to building wealth over time, leveraging smart investment strategies, the power of compounding, and good financial habits. You don't need to win the lottery, inherit millions, or be a financial guru to pull it off. In fact, all you really need to start is determination, a plan, and some discipline. In this video, we're going to break it all down step by step. We'll build a portfolio of high-quality dividend-paying assets and show you how small, consistent daily investments can snowball into an income stream that funds your retirement, all while starting from zero. By the end of this video, you'll see how even the smallest habits can result in big payoffs. We'll explore realistic examples, success stories, and actionable tips to get you and your future self on the right track. Starting from zero might seem overwhelming, like standing at the base of a mountain without any climbing gear. But here's the truth. Starting with nothing is a clean slate. It's an opportunity to develop the habits that will fuel your journey to financial independence. Let's face it, most people's budgets are already stretched thin with rent, groceries, bills, and occasional splurges. Saving might feel impossible. This is where creativity comes in. Side hustles to build capital. Imagine you're working full-time, but money's tight. How do you create that initial fund? You add a side gig. Side hustles don't have to dominate your life. Even a few hours a week can build momentum. Freelancing. Sites like Upwork or Fiverr let you monetize skills like graphic design, writing, or even voiceovers. For example, offering simple tasks like proofreading could earn $20, $50 per gig, adding up quickly. Driving for apps. If you have a car, consider ride-sharing or delivery services like Uber Eats. Working a couple of evenings could bring in $100 weekly, adding $5 to $10 annually to your starter fund. Pet services. Love animals? Platforms like Rover let you earn money by walking dogs or pet sitting. Spending an hour walking 2 dogs at $20 each nets $40. A simple way to combine exercise with extra income. Tutoring. Websites like Wisent pay upwards of $30 hour for tutoring subjects you already know, like math or English. Teaching even 5 hours a week generates $600 a month. What if you're not into traditional side hustles? Try selling things you don't need. Look around your home. Old gadgets, clothes, or collectibles gathering dust could easily become cash through platforms like eBay or Facebook Marketplace. Micro-investing apps. Automating small contributions. If side hustles don't appeal to you or time is limited, there's still a way to get started. Micro-investing apps like Acorns or Stash. These apps round up your purchases to the nearest dollar and invest the difference. For instance, buy coffee for $3.75 and the app rounds it to $4, putting $0.25 into your investment account. If you make 50 purchases a month with an average roundup of $0.25 done, that's $12.50 in automatic monthly savings. Over a year, that's $150. And you didn't even feel it leave your account. To supercharge this, consider adding just $5 daily to your account. That's $35 a week or $1,220 annually, enough to make your portfolio grow faster. Building wealth is less about how much you can invest right now and more about how consistently you can do it over time. Consistency is the golden rule. Start by committing a small, manageable amount, say $20 per day. This translates to $140 weekly or about $600 monthly. If that sounds daunting, remember you can scale up as your income increases. To automate this, set up recurring transfers with your broker. Platforms like Fidelity, Vanguard, and Robinhood allow you to automate contributions directly into your portfolio. This removes the temptation to spend the money elsewhere. Why consistency matters. Dollar cost averaging. This strategy means investing the same amount regularly, regardless of market conditions. Instead of worrying about timing the market, you're buying when prices are high, low, and everything in between. For instance, let's say you buy $100 worth of stock every month. If the price dips, your $100 buys more shares. If it rises, you buy fewer. Over time, this smooths out the ups and downs of market volatility, making it a stress-free way to grow wealth. Now that you've got your starter fund and consistent contributions, it's time to decide what to invest in. Dividend stocks. Picking quality companies. Individual dividend stocks give you control. Focus on companies with strong financials, stable cash flow, and consistent dividend histories. Look at industries like utilities. Companies like Duke Energy, DUK, provide essential services people need regardless of the economy. Consumer goods. Think Procter & Gamble, PG, or Coca-Cola, KO, which sell everyday products with global demand. REITs, real estate investment trusts like Realty Income, O, pay high dividends from rental income streams. Dividend ETFs, instant diversification. Prefer a hands-off approach? Dividend-focused ETFs like SCHD or VYM spread your investment across many companies, reducing risk. These ETFs are curated to focus on the best dividend-paying stocks. Dividend Reinvestment Plans, DRIPs, are an investor's secret weapon. Instead of cashing out dividends, DRIP automatically reinvests them to buy more shares. Over time, this compounds your returns. For example, you own 50 shares of a stock that pays $1 per share in dividends each quarter. Instead of pocketing the $50, you reinvest it. The next quarter, you own more shares, which pay even more dividends. This snowball effect is what turns modest portfolios into income-generating machines. Setting your retirement goal. To retire on dividends, you need to calculate your magic number, the portfolio size that generates enough income to cover your expenses. For example, let's say you need $2,000 monthly to cover rent, utilities, groceries, and a few extras. With a portfolio averaging a 4% annual yield, you'd need $600,000 to produce $24,000 annually in dividends. Achieving the goal. A realistic timeline. Let's break it down. Assuming you invest $20 daily into a portfolio yielding 4%, here's how your portfolio grows. Year 1, your contributions total $7,300 with dividends adding $290. Year 5, your portfolio is worth $49,068 and annual dividends reach $1,170. Year 10, your portfolio hits $171,400 with annual dividends exceeding $6,856. With patience, these numbers skyrocket. By year 20, reinvested dividends and compounding growth could push your portfolio over $2.8 million to generating over $50,000 monthly in dividends. Starting from zero isn't a setback. It's an opportunity. Whether you choose side hustles, micro-investing apps, or dividend ETFs, the key is staying consistent and reinvesting wisely. Every $1 you invest today is a building block for your future. So what's stopping you? Start small, stay focused, and let time do the heavy lifting. Want to see how $10,000 grows into $9 million? Click the video on the screen now.